of Rosenberg Research, and Ed Devlin of Devlin Capital back with us again now. And Ed, I heard you alluding to this before the break, and you talked about this last time as well. The idea that there's a lot of fear in the bond market, but that creates a little bit of opportunity in your view.
Absolutely. And, and there is, I think the thing that's the hardest part of judging, is this the top of the yields here, or is it here? I think, nobody knows. But, this whole recycling of debt away from the central banks and into the private sector it's a big thing. And, and I remember arguing with a few policymakers at the time when they said, oh, it's no big thing. I said, it's a really big thing. And I wrote an article at CD Howe kind of trying to quantify that. So it is a big opportunity. I would say, as an investor, it's time to average in, start to get going. Would I be limit long right now? No. But I definitely want to be involved in the market at this point.
And David, last time we were talking to you, in some ways you echoed what Ed was suggesting on taking a closer look at the bond market. You were a bit cautious on stocks, although I think you were thinking sort of heading into next year, maybe at some point you might give a closer look. I mentioned the TSX is negative for the year. I mentioned that the big technology companies, the S&P is technically negative this year. How do you feel about the stock market by comparison?
The math for the stock market is a big headwind, and I'll tell you why. And it comes down to the equity risk premium. What is the prevailing bond yield benchmarked against the earnings yield in the S&P 500? And it's south of 50 basis points. Sorry, I'm choking on my own forecast. Historically, we got to talk about ratios mean revert over time, and historically the ERP, the equity risk premium, is 300 basis points. You got to get paid to take on the risk to buy equities. Right now, you're actually paying to take on the risk instead of being paid to take on the risk. Big difference. So, there's going to be a time when I'm going to turn more bullish on the equity market, but it's going to need help from the bond market, which is why I'm bullish on Treasury yields. Treasury yields have to play a role in reestablishing a more appropriate equity risk premium to turn more bullish on the stock market, full stop.
Can I get your take on oil? We didn't really get to it last segment, but Tiff Macklem talked about, the Bank of Canada itself has now put $85 WTI as their new average, up about $10 a barrel since the summer.
Yeah.
It's awfully choppy out there in energy land right now.
I think that the E&P stocks, the exploration and producers, are rolling in cash anything north of $70 in WTI. And that's really, when you're taking a look at what was the bottom of the near-term range over the course of the past 6 months, was around $70. So we actually know what the near-term floor is. How high oil prices go is going to be determined on what's happening in the Middle East and how that conflict spreads. But I'd say that if you're looking for parts of the stock market that have visibility, energy is certainly one of them. And I don't think you have to have a view that oil's going to 100 or 120 or even 85. It could just stay in this range. And the energy sector is going to be a very good place for people to hide in what's still a very troublesome equity market.
All right. Well,